Hi, Salim Omar here from Straight Talk CPAs. One of the most frequent questions that we receive at my CPA firm Straight Talk is, should I form an LLC for my real estate business? Now, over the last decade, limited liability companies have become one of the most preferred forms of business entities through which to hold investment real estate properties. Prior to 1977, when LLCs came into existence, real estate investors seeking limited liability protection were largely limited to using corporations to acquire title, a form of entity that has potential drawbacks. The insulation from personal risk exposure for real estate provided by LLCs, coupled with the relative ease of administration and potential tax benefits, makes ownership of real estate, of investment properties through an LLC a very desirable case in most instances. LLCs limit personal vulnerability to potential lawsuits related to the property. Consider the situation where the owner of an investment property leases it to a tenant who decides to throw a big bash, a big party, during which one of the tenant's guests falls over a balcony. In today's legal climate, it's quite possible that the injured guest would pursue a claim based on the unsafe condition of the rental dwelling. More often than not, the owner would be named in any lawsuit resulting from this incident. If that rental property was owned by an individual investor, that investor would be named in the lawsuit and would have to defend his or her personal assets from the potential claims. In contrast, if that property were owned by an LLC, the owner's risk exposure would be insulated by the protection of the company, leaving only the assets owned by the assets as opposed to all of the owner's personal assets exposed to potential lawsuits. Real estate investors that rely solely on insurance as a means of protection from personal liability take a significant risk as well. Liability policies typically have limits, exceptions, and carve-outs. While the chance of a loss that exceeds policy limits may be remote, if it happens, the consequences can be devastating. Under current law and market trends, the popularity of real estate holding LLCs is very likely to increase as more and more owners take advantage of the benefits offered by this form of entity. Now, next thing I want to talk about is pass-through taxation for single and multi-member LLCs. And that's another advantage of an LLC, is that the owner's ability to enjoy the benefits of pass-through taxation. This enables real estate investors to avoid double taxation by acquiring property through an LLC while enjoying the liability shield. Under the default tax classification rules, the IRS classifies a real estate holding company with one owner as it would a sole proprietor, namely as a disregarded entity. As a result, income and capital gains from the LLC pass-through they flow directly to the owner, who would only have to pay tax as an individual while still enjoying the protection offered by the LLC's liability shield. Since there is no separate LLC tax, the owner can avoid double taxation on both the rental income generated by the property and the appreciation in value of the property upon disposition. Moreover, the owner of a single-member LLC can deduct mortgage interest similar to a sole proprietor based on current IRS rules. Real estate holding companies that are owned by multiple owners, by several owners, they're known as a multi-member LLC, and they're generally taxed by the IRS as a partnership. This means that the LLC files an information tax return but does not pay any tax itself. Multi-member LLCs also enjoy the benefits of pass-through taxation as the LLC passes its profits and income through to its members, who report their portion of the LLC's business income, on their Schedule C or on their K1 on their personal tax return. That means that both single-member LLCs and multi-member LLCs offer the benefits of pass-through taxation of profits and losses and limited liability and personal protection for the owners.